Hello and welcome to USAReverseMortgages.net, brought to you by iReverse Home Loans. My name is Brandon Webb. I'm your reverse mortgage expert. Today we're going to do a quick recap of some recent history in reverse mortgage. It's been a little while since we've had a video. You can always look to our site for videos or updates. We post articles and blogs as well. Today I just want to go over a couple things. First off, being the new jumbo product. There is a new jumbo product, some grumblings on that. We'll talk about that real quick. Also wanted to talk about some difficulties that may be coming for a HECM to HECM or reverse mortgage to reverse mortgage refinance. So it may behoove those of you who are interested to call us sooner rather than later, but we'll talk about that. Lastly, I'm going to go over the financial assessment and the effects that it's had on the industry. So first, AAG, one of the leading lenders in reverse mortgage, has recently said that they will be coming out with a jumbo product. We're kind of jumping the gun a little bit in that we don't know anything about the product yet. In recent history, the only company that's had a jumbo reverse mortgage has been Urban Financial of America, who's had the HomeSafe product. The HomeSafe currently has an interest rate of 6.99%, is available in a handful of major states, and can be used on several different kinds of properties. The loan-to-value amounts have been a little bit less than desirable, but they are, the only game in town right now. AAG is talking about coming out with another jumbo product. From what we can see initially, the only thing that they have discussed is that in certain cases, the borrower may be able to go up to 50% loan to value based on what they've released to us. That would be a little more desirable for the loan to value amount on jumbos. We don't, however, know what the interest rate is going to be, and we do know that they're not going to be releasing it to many of their channels. They're going to be trying it in-house for a little while. And once they get the kinks worked out, they'll release it. So look for more information on that here. The reverse is obviously a niche product that's not right for many people, but there are those specific situations where it is. Secondly, we're going to talk about HECM to HECM or reverse mortgage to reverse mortgage refinances. A lot of people don't even realize you can refinance your reverse mortgage, whether it be to add a non-borrowing spouse or get more money or a different interest rate. There are several reasons. Recently, the HECM to HECM has been a very popular product, and there is a guideline called the 5-to-1 rule, which normally we take into account, make sure that the borrower or borrowers are getting 5 times the cost of the loan in benefit. So if the loan is costing you $2,000, they'd want to make sure you're getting $10,000. Okay, that's the amount added to your principal limit. So long story short, they want to make sure that you're getting, it's worthwhile for you to do it. The last thing any of these lenders want to be doing is taking advantage of seniors. So HUD has some guidelines that help keep them honest. Not to say that they wouldn't be, but you never know. So recently there have been some ways to get around that 5-to-1 rule if there were compensating factors, such as you were coming from a cap 10 loan to a cap 5. A cap 10 means that your interest rate on an adjustable caps out at 10% above whatever your start rate was. And a cap 5 is the newer lower cap, obviously at 5% above your start instead of 10. So if your start rate was 2%, the old cap 10 means your interest rate could, over the life of the loan, grow to 12%. And if it was 2% under the new loan, it can only grow to 7%. So that's pretty desirable for people. So they used to let us get around, or well, some lenders still do let us get around that 5-to-1 rule to get a lower cap on the interest rate. Also, there are some borrowers who may just really need money, and their loan officer, like myself, a lot of us, including me, credit all of the costs depending on the amount of the loan. So we can do a very low-cost refinance depending on the customer's needs, and we're always willing to help that way. So in the past, we've been able to do that. Recently, AAG, actually the same lender for jumbos, has started to slow the refinance pipeline down for whatever reason, and has started to implement new rules that say that you have to stick with that 5-1 rule no matter what the extenuating circumstances are. Also, if you're going from an adjustable to adjustable, they want to see that you're selling the identical or lower margin. The margin is the portion of the rate that the lender makes. That, in some cases, is not possible. A lot of people who took their loans out around 2006, 2007, 2008, they were using a adjustable reverse mortgage called the CMT, or the T-bill. The T-bill offered a lower margin because it had a very high index. Nowadays, they use the London Interbank Offered Rate, or LIBOR. The LIBOR has a very low index and a higher margin. So in a lot of cases, with people coming in with that very low margin who may still need to do a refinance, whether it be for more money or whatever the reason. Companies like AAG have put out a directive that, at least for this moment, slow that down. As far as we know, all the other lenders that we use are not doing that. So we have that ability, obviously, to shop around, which is great for cost or rule changes like this. Lastly, I just wanted to discuss the financial assessment, give you an update on that. It was implemented April 27th of this year. Ever since implementation, it has had a big effect on the industry. People were talking about a 5 to 15% decline in business, and some loan officers I'm talking to are talking about a 50% decline. So it has had a big effect. The way that it affects the industry is, in the past, if you had a home with equity and you were over 62, you basically qualified for a reverse mortgage, barring some other small rules. Now they do review everything from credit to income, credit history, property tax payment history, homeowners insurance payment history. What they're looking for is what they call a willingness to pay, they being the lender. So they're looking for a willingness to pay. These rules were put forth by HUD, so all the lenders have them. What they're trying to do is determine if you need what's called a LISA, a lender-enforced set-aside. Sorry about that, tongue twister. A lender-enforced set-aside is put into place to make sure that you pay those property charges like property taxes, homeowners insurance, and HOA dues. Things that are required even though you no longer have a mortgage payment. So the one way to default on a reverse is to do that, to not make those payments. You no longer have a mortgage payment, so you don't have to make that, but you do need to still pay your property taxes, homeowners insurance, and HOA dues, things of the like. So if they determine that you do not have a history of a willingness to pay, they will decide if you need a partial LISA or a full LISA. And again, a LISA is a lender-enforced set-aside. A partial LISA means they'll take back part of the money they were going to give you as cash out and hold on to it and send it to you annually or biannually, however you need it to pay those property taxes, homeowners insurance, and those kind of bills. A full LISA means that they hold the money back from you, which will normally be more than a partial, and they will pay it directly for you. So what you may be wondering is, why does this really matter in qualifying for the loan? So basically it means most people can still get a reverse mortgage, but the problem is, let's say you're getting $20,000 cash out because you've got a large mortgage to pay off, so your cash out amount may be low, $20,000, $30,000. Well, then let's say they determine that, hey, your credit history is great, you've always paid on time, you've never had any issues with any of this stuff, property taxes, homeowners insurance, nothing. You don't need a LISA. So we're going to go ahead and let you have all your money, everything's great. Well, if they determine that you need a partial or a full LISA, they may ask you to set aside more money than they're giving you. So they may say, well, we're giving you 30 grand, but you need to set aside 40. And if you don't have that extra $10,000 to come in to close, then you don't qualify. Okay, and again, the LISA is determined by looking at lots of stuff. Income, credit, residual income. They're even going to take into account things like that, like how much you have left over at the end of the month after paying, all your minimum payments which show up on your credit report, your utilities, property taxes, homeowners insurance. They're going to break that stuff down. So the LISA is very useful in that it will help determine if people should be getting a reverse mortgage. A lot of us feel the guidelines are a little stringent and hopefully may be loosened in the future, although with FHA, HUD being a government organization, that may not happen. But it is useful. We definitely don't want to, make people think that it's just the man keeping everybody down. They do want to not be giving these loans to people who shouldn't be getting them. People who, after paying all these fees out of their equity in 12 months, 2 years, 3 years, will be losing their home anyway because they didn't pay their property taxes and homeowners insurance. So they want to make sure that either it looks like you do that for yourself and have the ability to do that for yourself, or they help you do it. That's pretty much it for this episode. Any questions or concerns you may have or a need for a reverse mortgage, you can obviously either call us or email us. We're always happy to help, whether it be, as I said, to sell you the loan itself or give you some education. We're there. Okay, so I appreciate it. Thanks for tuning in again, and I'll see you soon.